It usually starts late at night. You weren't planning to look at houses. You know better than that, but somehow your phone ends up in your hand, and you're scrolling through listings like it's a harmless form of entertainment. At first, it's just curiosity, then confusion, then a low-grade sense of panic. Every house that doesn't look like it's actively falling apart costs around $500,000. Not luxury homes, not dream houses, just houses. Normal, aggressively average places with dated kitchens, beige carpet, and bathrooms that haven't been updated since the early 2000s. And somehow every listing calls itself a starter home. You stop scrolling and start doing mental math. Your income hasn't changed, your bills certainly haven't gone down. And yet the market seems to be operating on the assumption that you, and everyone else, can casually afford a $500,000 purchase like it's no big deal. So tonight, let's stop pretending. Let's stop talking about what banks will approve. Let's stop talking about what's normal in your market. Let's stop comparing ourselves to people on social media who never show their balance sheets. Let's talk about the only thing that actually matters. One of the biggest lies in modern personal finance is the idea that loan approval equals financial readiness. Banks approve mortgages based on risk models. They are asking one question only: will this loan probably get paid? They are not asking, will you be comfortable? Will you be able to save? Will you be able to handle emergencies? Will this decision quietly dominate your life for the next 30 years? If the answer is you can probably scrape by, the bank is satisfied. Affordability, on the other hand, is about sustainability. It's about whether you can pay for the house and still function as a human being who occasionally needs to replace tires, visit a doctor, or experience joy. Those are two very different standards. In many parts of the US, $500,000 is no longer aspirational housing. It's entry level. If you're anywhere near a major metro area, or within commuting distance of jobs that actually pay well, $500,000 doesn't buy luxury, it buys adequacy: a modest 3-bedroom, a small yard, a house that looks fine from the street and deeply average inside. And while prices have exploded, incomes haven't kept pace. The median household income in the US sits around $84,000. That means the typical household is being asked to buy a home that costs 6 times their annual income. Historically, that ratio hovered closer to 2 or 3 times. That difference matters a lot. At 6 times income, the margin for error disappears. Let's talk about the first obstacle: cash. For decades, the standard advice was simple: put 20% down on a $500,000 home. That's $100,000. Not investments, not retirement accounts, not equity from your current home, cash. The median American household doesn't have anything close to that. In fact, the typical savings balance is under $10,000. That means most people aren't a little behind. They're operating in an entirely different reality. Even if someone earning $84,000 managed to save an aggressive 10% of their income every single year, it would take more than a decade to reach that down payment. And that assumes home prices freeze in place, which they won't. So people do what they're told to do, that they put less down, and most buyers put down USA for 10%. That's framed as a reasonable alternative, but it comes with consequences that rarely get emphasized. The first is PMI, private mortgage insurance. PMI is not optional. It does not protect you. It exists to protect the lender in case you default, and it costs hundreds of dollars every month. You are literally paying extra because you didn't already have enough money. That fee alone can easily run $200 to $400 per month. And it doesn't build equity. It doesn't make you safer. It just makes the loan acceptable to the bank. Let's run conservative real-world numbers. You buy a $500,000 home. You put 10% down. You finance $450,000. At current interest rates, your principal and interest payment lands around $2,700 to $2,900 per month. That number gets quoted constantly, usually followed by the phrase, "that's about what rent costs anyway." That's where the conversation usually stops. But that's not where the expenses stop. Owning a home means paying for everything that makes it exist. Property taxes alone can add $400 to $600 per month, depending on location. Homeowners insurance, which has risen sharply due to climate risk, can easily be another $250 to $350 per month. Then there's maintenance. The standard rule of thumb is to budget 1% of the home's value per year for maintenance and repairs. On a $500,000 home, that's $5,000 annually. About $400 per month. And remember PMI? Add that back in. When you tally everything up, your $2,800 mortgage quietly becomes a $4,300 plus monthly housing obligation. That's the real number, not the one in the listing. Financial planners often recommend spending no more than 28% of gross income on housing. If $4,300 represents 28% of your income, you need to earn roughly $185,000 per year. Banks are willing to stretch much further, sometimes approving buyers with housing costs approaching 40% of gross income. Even under that looser standard, you're still looking at $150,000 plus annually. Only a small minority of households earn that. which means most people buying $500,000 homes are not doing so comfortably. They're doing it precariously. Let's imagine a couple earning $160,000 per year. On paper, that sounds solid, well above median income. College-educated, stable after taxes, payroll deductions, and modest retirement contributions, they bring home around $9,000 per month. Subtract $4,300 hundreds for housing, they're left with about $5,200. Now let's layer in reality. 2 car payments, insurance, fuel, student loans, groceries, utilities, healthcare premiums. Suddenly that cushion evaporates. What's left isn't abundance, it's vulnerability. Being house poor isn't about luxury sacrifices, it's about constant calculation. It's checking your account before routine purchases. It's postponing repairs. It's hoping nothing breaks this month. Every unexpected expense becomes a mini crisis. A car repair goes on a credit card. A medical bill disrupts the budget for months. A job change becomes terrifying instead of liberating. And the cruel irony is that these households are doing everything right. They're working hard, they're earning good money, they're following the script is broken. Everyone involved in the transaction benefits when you buy. The bank earns interest for decades. The real estate agent earns commission. The seller cashes out. The insurance company collects premiums. No one is paid to tell you the truth. No one is rewarded for saying, this is too much risk. Once you sign, the stress becomes your problem. We've normalized financial strain as a rite of passage. Can't afford furniture? That's just part of owning a home. Eating cheaply to make the mortgage? You're building equity. Constant anxiety? Welcome to adulthood. Meanwhile, renting is framed as failure, as throwing money away. But struggling to afford a mortgage is also throwing money away, just with worse consequences and less flexibility. This is not about budgeting better. This is not about skipping lattes. This is not about working harder. Home prices have dramatically outpaced wage growth for decades. The math simply doesn't work the way it used to. Pretending otherwise doesn't make you disciplined. It makes you exposed. Wealth isn't just assets, it's resilience. It's having room in your budget. It's being able to save and invest consistently. It's absorbing shocks without panic. A house that consumes all your margin doesn't create freedom. It restricts it. The real question isn't, can I buy this house? It's, will owning this house make my life better or smaller? Will it give you flexibility, or will it dictate every decision you make? You are allowed to say no. You are allowed to rent longer. You are allowed to wait. You are allowed to choose stability over social pressure. There is no prize for buying a house you can't comfortably afford. The real win is making decisions grounded in reality, not expectations. A $500,000 house is not a starter home for most Americans. It's not affordable on a median income. It's not a failure to acknowledge that, it's clarity. Sometimes the smartest move isn't playing harder. It's recognizing when the game is stacked and choosing not to participate in that choice doesn't make you behind it. Makes you honest. If the math feels brutal, that's because it is. Subscribe if you want honesty instead of hype.